this is a project. The second thing I kind of said, one of the reasons I like this is because you have 7 vacant units. With everything that we've projected with this, being able to come in, do light freshen up. So you don't need big renovations.
So not big renos?
No, like we allocated $20,000 per unit. Some you'll need a little bit more than that, some a little bit less. And that also includes creating storage in the basement. So something that we've talked about on podcasts
to get some extra
before,
income.
adding at least 9 storage units, so 1 for each one. You could do more, but that's okay. You're ending this deal being able to have, a full cash out refinance.
Welcome back to REI Hot Seat. Andrew Hines here with Brad McCrae, and today I have no idea what we're talking about, so Brad's going to take it away.
Yeah, thanks again. As always, today we're going through a 9-unit building in Port Colborne, Ontario.
Awesome.
Well, yeah, so this 9-unit building here, I'll pull up.
Purpose-built?
It was originally mixed use. So obviously you had the commercial on the bottom. Many years ago, it was transitioned to be fully residential.
Gotcha.
So purpose-built to an extent.
Yeah.
So this is just an outside look at the building. Nice corner lot here. A few kind of high-level reasons why I love this building already is you're getting 7 vacancies right off the hop. You're buying with 7 vacant units.
7 vacant units.
7 out of 9.
Okay. And is that a good place to have vacancies, Port Colborne, Ontario?
So it is in the sense of, if you're someone that's following kind of in that Niagara region, there's the massive battery plant that just got announced. It's going to be coming, $1.5 billion investment into the area. 1,000+ jobs are coming. So there is a big spike of demand.
Spike of demand for housing.
Yeah.
And I mean, you hear this narrative in Ontario that rents are softening, at least a bit. And I think a large part of that's because of immigration. But if you look into micro pockets, you're going to see some areas that rents go up. And this could very well be a spot for that.
Exactly. I feel Toronto is one of the spots that softened the most because of the amount of rental units possible, like the total amount of condo units out there.
A lot of condo
and then
units.
with the immigration already, like kind of combined with that, you started to see people that didn't have to leave Toronto anymore because of pricing in the I'm going to call it the entry-level rent spaces, or rental prices, and that just echoes out across. But when you have little pockets where someone wouldn't be choosing between Port Colborne and Toronto, so it's not necessarily the flow through of decrease.
Yeah, there is a ripple effect with Toronto, but Toronto's its own thing because I think a lot of immigrants come to Toronto first and then realize, why am I in Toronto? We might as well just move out.
Yeah.
So there's that natural softening. Yeah, they'll use up the units at first, but then they'll naturally leave. Whereas other places, you're already getting, like, it's not really any cheaper to leave Port Colborne and try and find a cheaper spot.
Exactly. Yeah. As long as you have a self-sustaining community there where you have jobs that support what you need, you're not going to see that as much.
Yeah. Yeah, okay. So they do, I mean, one of the things I love about Port Colborne is just how close it is to the U.S. border. Yeah. Like, you're just so accessible being down there.
Yeah, exactly.
Now, it'd be interesting, I guess, what would have happened if the tariff had come in. What happens to these, like the battery plant, the infrastructure? It's a little bit of a tangent here, but that's a lot of the speed of implementation of what was supposed to be the tariff that was supposed to come in didn't make sense to me for all the planning and infrastructure that large companies have paid for.
A ton. And
to just hit them all of a sudden, hey, slap.
Yeah.
I know you just spent $3 billion, but slap.
Yeah, $3 billion just of research to figure out if this is even the right spot to do it. And then it no longer makes sense. It's no longer viable. So
which is why I sort of doubted that it would happen.
Yeah.
And it was more of a bluff.
It was,
which it very well might have been. It might have been, but who knows? It might still. By the time this airs, it might have actually come in. But as of right now, 30-day pause on that.
Exactly. And I saw one, and I'm not sure how accurate this is, but it was like one of the big things that they were doing with the tariffs. One of the reasons for Canada is like the fentanyl into the U.S.
Yeah.
And I saw a stat as like 4% or less than 4% or something comes from the Canadian border. It was like 95% comes from the Mexican border. But it's like treated as equal. It was just you can't do one to like without the other.
Yeah, I mean, and I know we're on a tangent, but I like this tangent. My thought on the whole reason that he was doing it was that, I mean, he's openly said that he wants tariffs instead of income tax.
Yeah, I saw
so that was just like the first step in that plan, like slapping Canada with the 25%. That's a start, and then there's obviously more that would need to be done. But
and last thing I'll see is like I'm pretty sure he just signed in, and the executive order like trying to get rid of income tax. And like, it's something he truly wants to do. And I feel like if anyone is to do it, it's him. Or like get rid of the taxing, sorry, not income tax, getting rid of taxing in the US itself.
Taxing in?
Tax within the US.
So that means all income taxes.
Yeah, like it shouldn't be the video that I saw was essentially him saying like, we shouldn't tax the US citizens. We should get all of the money that supports where normal property tax and normal taxes come from within tax to other countries.
Yeah.
And I think,
I mean, in the long term view, man, would that ever make prosperity in the U.S. long term? Short term, it'd be rough.
It'd be a weird like 5 to 10 year transition period.
Like I mean, there'd be a day where there would be all the manufacturing back in the U.S. because it would just, you wouldn't need to make as much money to live a good life because you weren't being taxed taxed to death. The inflating the currency is still a tax though. So as long as the Fed still exists and it will still print money and manipulate currency, I mean, that's just a hidden tax. So they could still tax you that way.
Exactly. Yeah. Like it'll be interesting to see. I mean, I feel like every 15 days, every day, you're not sure what's going to happen and what's coming up.
That's true. Yeah.
But
yeah, it's an interesting time to just kind of observe things.
Yeah.
But anywho, so let's talk about this building. It was a great tangent. I love these tangents. Okay, so back to the deal. Not exactly perfectly purpose built, but a pretty cool unit. Colborne, Ontario. So it's got some good economic fundamentals coming its way. So these are announcements, like it's confirmed. The battery plant's coming.
The announcement came out like sometime last year. It hasn't started yet, but it's on the way.
My favorite time is like when money's already been spent.
Yes.
Some money's been spent.
Exactly. Yeah. It's money that is coming that, barring massive changes like we just chatted about, it will be going through.
Gotcha. Okay. So, and then of course, just you have the stability of that area in general, being that it is, it's in the sort of GTA area, not quite, but it's accessible.
Exactly. Like as you mentioned, it's very close to the border, and then being close to the border, you have being close to Niagara. So that you're seeing as people left the GTA to go to outside to get more affordable, people are leaving Niagara and St. Catharines, and Port Colborne is the more affordable spot, while it still provides access to it.
Yep. Yeah, and I've long said that people, as long as you have infrastructure, if you're in an accessible area of Ontario, especially with our population crisis, like you're gonna have people living there.
Exactly.
I mean, rent prices will fluctuate, but you're gonna have demand for those areas.
Exactly. And so this is a project. The second thing I kind of said, one of the reasons I like this is because you have 7 vacant units. With everything that we've projected with this, being able to come in, do light freshen up. So you don't need big renovations.
So not big renos?
No, like we allocated $20,000 per unit. Some you'll need a little bit more than that, some a little bit less. And that also includes creating storage in the basement. So something that we've talked about on podcasts
to get some extra
before,
income.
Adding at least 9 storage units, so 1 for each one. You could do more, but that's okay. You're ending this deal being able to have a full cash out refinance in less than a year.
So a perfect BRRRR here.
Perfect BRRRR.
Okay. Why didn't you just say so? That's how we should have started the episode.
Perfect BRRRR.
I usually ask why should anybody care about this deal? Okay, so a perfect BRRRR. So this is a value add play, but it's not a huge value add.
Correct.
Looks like your unit mix is mix of 2s, 1, 3, and then the rest 1s.
Yes. Yeah.
Yeah. So split between 2s and 1s, and then
4, and then a 3-bedroom.
Okay.
Yeah.
All right. And then where are we? So the ones that are rented are not terrible rents.
No, they're not. They're a few $100s off.
Like
market? the 1-bedroom, you're about $250 off, and then the 2-bedroom, you're about $500 off.
So what would a 2-bedroom? What should I rent for? It's a little small on my screen.
About $1,900.
$1,900.
Yeah, and okay. We have the reason that we put this in. Like we'll have some people. I've already had some people say that seems high for this area, and we have other investors, other clients that we work with that like this is a, on that borderline of conservative, and they're getting these for units that won't be as nice.
All right. So leave the ones that are rented alone, just renovate the others.
Correct.
And that's your sort of pro forma plan.
Exactly. Yeah. Like with, if we had a building and there was 9 tenants inside, we wouldn't say, it's a reasonable thing to expect all 7 to get out or 9 to get out within a year. But because you have the straight shot of this, as soon as you take over, like you can start right there.
Perfect.
So as I mentioned, we allocated $20,000 per unit to have this done. Approximately like $10,000 to do the storage unit. So you're literally just putting up the cages that we've talked about before, maybe some wood paneling around it, but it's very, very minimal cost there. And then building in a contingency of 25. So the total, budget for renovation or, whatever you want to call that, 175,000.
And your approach to value this on the back end is you just applied a market cap. Like, what cap do you feel that is warranted in that area for like the freshly renovated?
Yeah, for this type of product, we are looking in the low 5. So 5.25 is what we had. We have another client that was actually getting like 5% and 5.1 on a refinance very recently. So we, again, tried to be a little bit conservative there.
Okay. So 5.25, you ran that number with the new income.
That's correct.
Okay. And why do you think, is this like just because less investors are looking at Port Colborne that you can get a little bit better a deal on the acquisition? I mean, because a 5 cap or 5.25 cap is like a prime area.
Yeah. And I would say it's the difference of what purchase and sale would be versus what appraisals are coming in at. There's enough evidence to support this from an appraisal point of view. But I would not, as an investor, I wouldn't be buying at that.
At 5.25.
Exactly. Yeah. And that's kind of what we're seeing a lot in the secondary and tertiary markets is there's a pretty big gap between the appraisals and what things are being transacted
being traded out.
Yeah.
Because it takes the appraisers a while to catch up to market changes and such, right?
Exactly. And just with the fluctuations in interest rates and bond yields that we're seeing, especially recently, but there's enough evidence within the last 6 months to support this cap rate and this price per door in that area.
So what's the cash flow going to look like? Well, first off, is this like a CMHC play?
Yeah. So it would be CMHC standard,
85%?
Standard CMHC. It's going in at 80. And that's being constrained by a 1.2 debt cover.
Okay, 1.2 debt cover is needed, and you're doing 40-year AM.
Yeah.
And what's the cash flow look like?
So you're cash flowing just under $20,000 a year, and that includes your appliances. That percentage of rent isn't calculated properly. It's supposed to be 1, but the numbers are right. So 1, you have your appliances. You have everything built into this on 7 of the 9 recently renovated units. So your actual cash flow will probably be a little bit higher, but of course, with
you're
CMHC,
saying you're budgeting for appliance replacement?
The appliance reserve for CMHC.
Oh, they do that?
I think
I knew there was a replacement reserve. I just didn't know they referred to it specifically as appliances.
Yeah, there's a special line for that. I think somewhere between $30 and $50 per appliance that they want, minimum of 3 per unit. Yeah,
per unit per year.
Yes.
Okay. Which, I mean, that seems totally fair.
Yeah, I mean that's reasonable.
Yeah.
But yeah, you have that. You have your CapEx reserve. Like we've built everything into this, and you're still cash flowing 20 a year.
Okay. And what's the commitment to come into this? Like, how much money is somebody bringing into this deal?
So it's the sale or the purchase price right now is 1.6. The total amount of capital you'll need from that, the renovations, carrying costs for the year is $760,000.
Okay, so you got to have $760,000, but you can refinance it all back out.
Refinance it all using the numbers we have at roughly $50,000, and also we're seeing a product like this getting interest rates right now in the lower 4s, like 4.1, 4.15. We were a little bit more conservative with 4.4, so there's a chance that you could have a better loan to value.
Well, the yields have been coming down.
Yeah, exactly.
Well, and I just found out that the Bank of Canada literally just stopped quantitative tightening. At his most recent meeting, they just announced they stopped.
I did not hear that.
So they were doing it all the time. So they were forcing yields up this whole time.
I didn't know that it was just like they just finished it yesterday.
Yeah, I had no idea. I thought they would have finished that a long time ago. So now that that's stopped, we're likely to see the yields come down a bit.
Yeah, I'm pretty sure I saw somewhere, and this was based on us getting the tariffs. Whatever it was a week ago, that we were going to see 6 consecutive. 0.25 basis points. Now we're not sure, but
that was the BMO announcement or prediction. So right now we're at the top end of the neutral rate. So the basically the rate that's not stimulating or depressing the economy, but we can go all the way down to 2 and still be within the neutral rate range. So I think that there's a good reason to expect that.
Yeah, I feel like, and this is the one thing when you're doing these calculations on a project that's a year out from now, you have to make a best guess of what it's going to look like. Well, but I feel like it probably, like, you know, unless some massive things change, as we say, probably won't get worse.
Yeah.
Or go higher.
It's tough to say. What would you say if the tariffs did come in? What would that do to rents? It's so hard to know.
And that's because
I mean, I think if that, like, it's an inflationary thing. It's inflationary if we retaliate.
Yes.
And if it's inflationary, like, assets grow. Like, people put their money into assets.
Yeah, interest rates will come down, or they'll be forced down in the short term to like. It's so tough because
that's a stagflation event, right?
Yeah.
So your economy's not growing and your inflation's up. You don't want that. That's a very bad scenario, but that's what that sort of creates.
Yeah.
It's a great thing. At least it seems like right now it's a great thing that those tariffs didn't happen, and hopefully they don't.
Yeah, it was interesting to see how much our side, you know, Canadian politics, said we're going to retaliate. Then within one day, it was like, oh, just kidding, we're going to block that all off. But I would say if they do come in, like, it's anyone's best guess. I haven't been alive. I haven't researched like anything similar to this to know what would happen 6 months out, or a year out, or 5 years out.
Yeah, I would have to ponder that a bit in terms of like the ripple effect that comes from it. But definitely not something that we're going to prefer. I mean, I think in this whole scenario, Canada really, like, Trudeau should never have come out threatening back. I mean, we're like 2% of the U.S. GDP spending on importing our oil. Like, we're so insignificant to them, but they're so significant to Canada. And that's not somebody you threaten and, oh, we're going to put a tariff on you. Like, that literally means nothing in comparison.
Yeah. Did you?
So,
what was it? Elon Musk tweeted back at Doug Ford about canceling the Starlink. And he replied, Doug Ford said, we're canceling the $100 million Starlink deal. Yeah. And Elon Musk replied, LOL, like in a tweet. And it's just like, we are insignificant to them in the stance, but I feel like everyone just our politicians had to stand up for people. They feel like they haven't been for so long, but this wasn't the time to do it.
No, that was in my opinion, a very, very bad. And I had people reach out to me and say, no, you're wrong. What were we supposed to do? I'm like, if you tariff American goods, you punish Canadians.
Yeah.
Now the food that we need to eat in the winter is now more expensive than the inflation 3 years ago already made it.
And the carbon tax, like, we'll see if that because it was supposed to go up
April 1st. 20%. Yeah, I mean, it's a circus. It's a circus out there.
Yeah.
But yeah, no, I like episodes like this, and we could have just done one. What I want to do is when we have when we're gonna release one 3 days later, we'll do like a full update.
Exactly. Like, I feel like we'll have one, especially if the tariffs do get imposed. After that 30-day mark.
Yeah, for sure. Okay, so any other thoughts on this building? Things that a buyer would want to know that we should share?
So a couple of things that I didn't mention. So the only utility that's paid, which is another good thing, is water on this. So hydro and heat, they are separately done. It is a boiler. So there are more upgrades that can be done to make this even more efficient.
So central boiler, so you're going to have central gas then?
Correct.
Mm-hmm. Okay. And then central water meter?
Correct.
Yeah. Now, are there heat pumps in the units too, or no?
I don't believe so. No,
it's something that's a future upgrade you could do. And
yeah.
And heat pumps are getting so cheap now. So
I haven't seen.
I saw there's a couple on Amazon now that are run on 120 volts that are like $850.
I saw them like in the thousands before, but then the quote that I got to install them were crazy. And that's the
life hack. I'll throw this out. Like, go buy a Senville on Amazon.
Yeah.
And then just hire an HVAC guy to install it. Pay them $1,000 or $800 to install. I paid a guy $800 to do one in my garage.
And that's what I find is just having your guy for whatever it is. Like, most of the time, they don't care where the product come from.
Yeah,
as long as they get paid what they want. Well,
and they want to mark it up and whatever. But I mean, if you're dealing with like somebody with a new company, they're gonna install it because they're gonna get referrals from you in the future. Like, they'll do you a favor. And I think that that happened for me, and it's easy enough. Like, you can DIY this stuff. Not that you're gonna want to, but if you even if you had a handyman, this isn't advice. I'm just saying, functionally, I could see how anybody could just watch a YouTube video and do it themselves.
Yeah. We're getting to the day and age you can probably watch a YouTube video for most things.
Between a YouTube video and ChatGPT, I literally show ChatGPT pictures of what I'm working on. I'm like, didn't work. Look at it. I see your problem.
Not for anything house related. I just moved, And the one plant that I've kept for 5 years, like died over the move. And I took a picture. I was like, "What's wrong with this?" And it gave me a big list of things. I was like, I used to have to pay for an app for that. And ChatGPT, just as soon as it can come out with the videos, like if you can ask it a problem
and
instead of linking to a video, it just makes the video for it.
Well, it can
it's
make
closed.
videos now.
It can make videos, but like being able to take the information it learns, like research and create the video.
Yeah, since this is an episode of tangents, I mean, I heard someone say that it's the computing power that'll be the problem. Like the AI, like it's already capable of doing so much, but it's like the bandwidth and like CPU computing power.
Yes.
And I can tell from experience that they throttle ChatGPT back. Like it says things that are so stupid sometimes. I'm like, did you even read the document I uploaded? Like you'll be on a roll, and then all of a sudden the quality of answers just hits the floor.
Yeah.
And I just, I've realized that they're throttling it. And I've heard that it's going to be like another decade before there's enough CPU power to really power AI for everybody. So for now, we still get the light version, but it's still incredibly helpful.
It has made such little things so much easier to just research. Like you're able to complete very, very small tasks in seconds or minutes versus hours.
Yeah, 100%.
Across the board.
100%. So episode of tangents, but I enjoyed it. And I think this is what we used to do on the podcast back when I hosted it. I think a lot of people like that. So please enjoy this episode. And if you did enjoy it, show us some love, like, subscribe, leave us a comment. If you got questions you want us to cover on the show, that's the best way to do it.
Yep.
And I'm going to remind you about the insiders list. So REI Hot Seat Insiders List. This is where you join if you want to get access to off-market deals. I didn't even ask you. Is this one off market?
Yes, it is.
Yeah, like deals like this one.
Yeah, get them sent to you first.
Yeah, sent to you first. You get a chance to review them first. If you join the list, you'll also get a call from a member of the team and just kind of their way of connecting with you, kind of assessing what your goals are and going from there.
There we go.
So buying, selling, that's where you want to go. Anyways, the link will be below the video or if you're watching on the podcast platform or listening on a podcast platform, it's in your show notes.
Yeah.
Thanks a lot, guys. Thanks, Brad.
Thank you.
See everyone next week.